Welcome to the 7th episode of How to thinkScript. We are TOSindicators.com, home of the Volatility Box. Using the Volatility Box, our profits for the month of August are just over $13,000 trading a 2-lot in a small account. Our goal is to make the Volatility Box the single most powerful indicator in your trading arsenal. If you'd like to sign up, head on over to TOSindicators.com/volatilitybox. We're down to our final few spots left at the discounted monthly rate of $97 a month, after which the price will increase. As always, you have a 30-day risk-free trial. If you're not happy for any reason, if you don't make money, just send us an email and we'll give you your money back. For today's tutorial, we're going to walk you through how to build an indicator that lets you determine which one of the 4 market stages we're currently in. Whether it's acceleration, which deems to be a little bit more aggressive, distribution, which calls for more conservative strategies, deceleration, which once again calls for aggressive strategies but using puts and so on and so forth, or accumulation, which once again calls for conservative strategies. Today's tutorial was requested by 2 separate members. The first part, which is related to the volume-weighted moving average, was a request by Ron, one of our awesome subscribers, a top-notch trader, and an even better musician who used to play on tour with foreigners. I'll go ahead and link his music in the description box below if you'd like to give it a listen while you code along. The second part of the tutorial was requested by a member by the name of Alan. Alan asked if we could build the latest workspace that John Carter will be sharing in his newest class. I'll take a second to say that JC is a godsend of a trader and he has a phenomenal pulse on the market. However, if you're like most other traders, you're tired of paying $1,000 every couple of weeks to figure out what's been missing in your trading all along and how you can finally get those consistent gains. Well, in this tutorial, we'll try and recreate this workspace for free. If you'd like to skip the tutorial and start playing with the workspace right away and all of the different tools and bells and whistles that we've added to it, they're available for download for free on our website. The link is in the description box below. However, if you'd like to build the indicator yourself or figure out how it's built, then keep listening. This tutorial is a little bit long, so we've divided it into 3 separate parts. In the first part, you'll learn how to build the volume-weighted moving average along with the variable moving average. In the second part, we'll combine these 2 tools together to create an indicator that lets you easily determine what stage of the market we're currently in. And finally, in the third part, we'll build utility labels and scans that make it really easy to view and find trading opportunities on the go. Let's get started. Before we write a single line of code, let's first understand what it is that we're writing. So to essentially assess which market condition we're in, we're going to be using 2 separate moving averages. The first one is called the volume-weighted moving average. And what the volume-weighted moving average is it's a moving average that takes volume into account and it gives closes with higher volume a higher weight. So let's say, for example, you had a close with, say, on the S&P with 5x the volume that it usually has. Well, the volume-weighted moving average actually takes this into account and reflects it on the moving average. The second moving average that we'll be using is called the variable moving average. The variable moving average is built into thinkorswim, and we'll be taking that code and making it a little bit better. But the thing that makes the variable moving average so special is that it automatically adjusts the smoothing constant using market volatility. What that really means is you have a moving average, so let's say a 21-period moving average, that has actually automatically accounted for the market volatility that we're currently experiencing and has adjusted the smoothing constant to reflect that. You'll see this as we go along, what each of these moving averages looks like and why they're useful. Now, let's get started with writing some actual code. We'll start by clicking the studies icon. And instead of clicking create right away, we'll actually first pull up the variable moving average code that is built in to thinkorswim. Once you type in variable, then you should see a variable MA pop up. This is the built-in thinkorswim study for the variable moving average. We'll click the locked icon with the scroll, which now open up this code. We can go ahead and copy paste all of this code in, and now click create, and we'll paste this code in, and we'll give this study the name TI Market Pulse. Now we can go ahead and remove this. We know it's a TD Ameritrade code, and this essentially should plot just a moving average that's the variable moving average. So if we click OK, and we change this to, say, the 21-period variable moving average, we should see a line plot on the chart. which is what we do. This is the variable moving average, which is essentially the founding block of what we will be using to determine this market condition. Now, if we come back into the code, we can start editing this code. So we have the variable moving average in, but we also want to bring in the volume weighted moving average to start to determine things like trend. We want to measure the relationship between the 8, the 21 moving averages and the 34, but we want to do this not using the exponential or the simple, but let's take volume into account as well. So to go ahead and create each one of those, we'll use the calculations. Now, for the volume weighted moving average, you can Google this. The calculation is available all over the web, but the essence is you're taking the sum products of the volume and the closes and then dividing by the actual volume. So the way we code this is def V, and we'll call this VWMA, and this will be the 8-period volume weighted moving average. And we'll say this is the sum of the volume times the close for 8, essentially the length, which is 8. And then we divide this by the sum of the volume over the past 8 bars as well. This now gives us the volume weighted moving average for the 8-period moving average. Let's go ahead and repeat the same process, but for the 21 and the 34. And so we copy paste them in, and we can come in and we change this to 21, this to 34, and we change each of the lengths as well. So after doing this, what you have now are 3 volume-weighted moving averages that are not plotted, along with the actual variable moving average, which is plotted. Now, let's take this information and do what we normally care to do. So most times when people talk about a really strong trend, something that's uptrending, they always talk about stacked moving averages. So let's bring in the concept of stacked moving averages, but this time we'll use the volume-weighted moving average. So the way we do that is by saying def bullish is equal to if, and then now we want to see if the 8-period volume-weighted moving average is greater than the 21 period. And then we'd also like to see if that is true, then we want the 21 to be above the 34. And this essentially is our version of the stacked moving averages. And if all of this is true, then we'll say 1, which is true. Otherwise, return false, which would be 0. We repeat the same exercise, but for the bearish side now, and we'll just reverse each one of these signs to essentially say less than, and we'd like to invert everything, right? So now we want to make sure that the 8 is below the 21, and we want to make sure that the the 21 is less than the 34. So now we know that they're stacked to the downside. And once again, we'll add in our Boolean conditions, and now we have bullish and bearish scenarios. The last scenario that we need to add in is a distribution scenario. What happens if the moving averages aren't stacked? Well, then we know we're in essentially a period of chop, or at least relative chop compared to a trending market. And so we'll say def distribution, and we'll use the 2 variables that we've said. So if it's not bullish and if it's not bearish, then we know it has to be in distribution. And so we can go ahead and write that condition in. And now let's go ahead and actually write our first label that brings all of this together to let us know, are we in a period of acceleration, deceleration, distribution, or accumulation? So we'll write that in. We'll say add label, and we'll say yes. So we always want to show this label in. We'll add in a condition that lets the user change this later on, but we'll say if bullish, then we want the stage to say acceleration. Else, if bearish, then we want the stage to say deceleration. And finally, else if the close is greater than so essentially now if we're above the variable moving average, but we're not bullish or bearish, then we know we're in a stage of accumulation. So we'll say then stage accumulation. And finally, if we know that none of these conditions are true, then it leaves us with the final stage, which is distribution. So we'll say else stage distribution. Now we can also go ahead and color code this in. So if it's bullish, then we'd like it to be a green label. If it's otherwise, we'll say else if. If we're bearish, then we'd like this to be a red label. And finally, if it's neither of those, then we'll say we'd like it to be, we'll call it else, and then we'll say if the close is greater than or equal to the variable moving average. So this is the condition in which we're in the accumulation phase. We'll give this the color of yellow. And finally, we'll say for anything that's in the distribution phase, we'll give it the color of orange. Okay, so let's test if this actually works. This is our first essentially struggle, or try rather, to see whether or not we can get a label plotting that tells us what stage we're in. If we click OK, we should see a label that confirms that we are in fact in a decelerating stage. Let's try a few different variables. So we have SPY. Now let's try a stock ticker that's been on an uptrend trajectory rather. So we'll put in Roku. And we see that we're now in acceleration phase. Cool. So we can easily see using a label whether we're in the accumulation, distribution, deceleration, or distribution phases. I think I covered all four. But now what we'd actually like to see is this reflected on the variable moving average line. We want the line to change colors to make it even simpler for us to know that, hey, this is when a switch is happening, to be able to recognize when a switch has happened, because according to JC in the webinar, that's when the most powerful moves actually happen, when you switch from accumulation to acceleration, or distribution to deceleration, or vice versa. So we'll go ahead and actually change the colors. So we take the VMA variable that we created up above right here, or actually that thinkorswim created by default with their code, and we're going to assign a value color to it. This is what lets the actual line change as the values that we like to look at change. So we'll give this a assigned value color, and we'll say if bearish, and we'd like to see if the close is less than the volume or the variable moving average. Then we'd like the actual variable moving average line to change to a red color. Else, if we're now bullish and the close is above the variable moving average, then we'd like the variable moving average line to change to a green color. And finally, if none of those are true, then let's just stay with the plain gray color, which tells us that we're in a distribution phase. So now if we hit OK, this should change the actual line, and all of a sudden we have a line that lets us see easily when we're switching from, let's say, distribution to acceleration to essentially distribution again to a deceleration back to an acceleration where we get this drastic move up. We come back, we touch the variable moving average line. We're in a period of accumulation rather, and then now once again we're jumping up from there, and now we're in a period of acceleration currently. Let's bring this back to the SPY, and we see something similar. We can easily tell when we've switched from a period of accumulation or distribution into acceleration. This is essentially where JC talks about going really aggressive, buying out of the money calls, Delta 30 he talks about. This is essentially your switch period where you can capitalize on that. The distribution period, you see very clearly, we're just chopping around. So things like an iron condor or spreads, if you have a directional bias, are a little bit more useful. Once again, we're in a period of acceleration. You see the switch very clearly. And now it's how do we take advantage of this? Well, let's go ahead and actually address that. Now, what we'd like to add is essentially some sort of a signal. Maybe it'll be a chart bubble or an arrow. We can figure it out. But where we see these switches actually take place, and we make these switches really easy. And now there's twofold benefits to creating some sort of variable that tracks these switches. The first is that it's really easy for us to see that, hey, we've gone from a period where the line is gray into a period where the line is starting to be green, or acceleration is kicking in. So it's just visually appealing and really easy to see. But the second will be relevant in part 3, which is creating actual scans for this feature. So let's go ahead and create a variable that lets us track when we're switching from either phase into a period of acceleration or into a period of deceleration. So we'll say accumulation to acceleration. And we can say, we can define this by saying, okay, so if we're bullish and the close is above the volume weighted moving, or the variable moving average, then 1, else 0. And we can add an actual chart bubble that plots only when this condition is true. And we want to make sure that this condition was not true on the previous bar. That's essentially what tells us that this is the candle in which the change has actually happened. So we give it the array of referencing the previous bar. We'd like to plot it at the close of the previous bar. We'll just say we'd like to plot it at the close. we'll give this, say, some nomenclature like buy out of the money calls, and then we can add the color where we make this a green chart bubble. So let's see if this actually worked. Okay, so what we should see is these bubbles plot only when we've actually had a switch. Now, this doesn't mean that it's going to be correct all the time in the sense of you should always buy out of the money calls, but this does tell you that we've switched. So maybe instead of saying buy out of the money calls, we'd like to say that we're entering acceleration. And you can have some fun with this. If you want to make the label something funny, something clever, something witty, go for it. We'll keep it simple for right now, and we'll go ahead and do the same thing, but for the distribution to deceleration, and we'll say if, and the same exact condition, so bearish and close is less than or equal to the variable moving average, then 1, else 0. And then we'd like to have the same chart bubble, so we'll copy paste that in, except this time the condition that we care to look at is the distribution to deceleration. So we'll replace each one of these variables where we look to see whether this candle we've switched from distribution to deceleration, and the previous candle that was not true, and then we'll change the entering acceleration to say entering deceleration, and we'll change the color to now be red. So let's see if this plots as well. All right, so that works the way we intended it to work. We see a whole mess of series here where we're entering deceleration, going back into distribution, deceleration, back into distribution. So this could really be summed up more like chop, but we also see like right here, for example, where we entered a period of deceleration and then continued to go down. Same thing happened right here. And this was the last period where we entered acceleration, but we really didn't get much of acceleration because we ended up switching into a distribution and then deceleration phase, where you see we continued to fall, and we got a very clear notification that, hey, we're now entering a deceleration phase. Let's go ahead and remove each of these drawings. So this, in a very simple term, or simple basis rather, gives us the 4 stages. We have a label, we have the chart bubbles plotted. Let's go ahead and make these chart bubbles configurable by the user. So we'll add in an input at the top, and we'll just say input chart bubbles on, and we'll set this to no by default. And we go ahead and copy paste this variable in, and we'll add this condition to the very first of our chart bubbles, which is the Boolean condition that says, hey, if this is true, then only go ahead and do the rest of the statement, which if the user said no chart bubbles, then this entire chart bubble condition will render false. So now what you should see is the chart bubbles are off. We can come in, we can click yes, and all of a sudden the chart bubbles turn back on. Now in part 3, we'll turn this into labels. We'll add labels for all the ETFs, so things like the SPY, the QQQs, the semis, each of the SPY sectors, so on and so forth. And we'll also bring in things like the TRIN and the put-call ratio to start to give us a full holistic idea of what stage of the market condition we're in. All right, let's bring this home in part 3. First, we'll click the studies icon and copy and paste all of the code that we've created in our market pulse indicator to create the scans first. We'll copy paste the code, head on over to the scan tab, and we'll edit. And sorry, if you don't actually see this, let's start it from scratch. So we'll click add study filter, then we'll come to custom, click thinkScript editor, the tab, and we'll copy and paste all of our code. Now what we should see is an error that says add label is not allowed in this context. We need to get rid of all of our add labels, our add chart bubbles, anything where we've assigned the color. And we can change our plot up here of the variable moving average to a def. We can also remove this color. Now what we see is the error that we've received is at least one plot should be defined. So let's go ahead and scan to find essentially the tickers that are moving from an accumulation to an acceleration phase. So we'll change that def to just a plot, and this will essentially return true if this condition is true and nothing else. We can also remove this miscellaneous code up here of the chart bubbles, and now we click OK, and let's run the scan. What we see are a bunch of results, and these results should be tickers in which we've moved from accumulation to acceleration. So let's take 2, for example. We'll come and we'll look at the chart. We'll pull up TTO. And we see that this is in fact not true. This didn't just change from accumulation to acceleration, but rather has been in a period of acceleration. So let's come back to the code in our scans, and we'll say if bullish and close is greater than or equal to the variable moving average, and we want to make sure that it was not bullish on the previous turn. So we'll click OK. Actually, sorry, need to also add in the array here to reference the previous bar. We'll click OK and run the scan again. What we should see is only 2 results this time. So if we come back in to our second chart, let's try WPM. And here we see that we have in fact moved from a period of accumulation to acceleration. Let's check the second ticker as well, which is the utilities ETF, and we see the same sort of story. Cool, so we've just created a scan that lets us very easily find and identify tickers that have just moved from a period of accumulation to acceleration. Now let's save this scan as accumulation to acceleration scan, and we'll click save. Now we'll repeat the same for the distribution to deceleration. So we'll change the accumulation to def, and we'll change the distribution variable to a plot. Here, once again, we'll add in the same fix that we learned. So we'll say and it should not have been bearish on the previous bar. And if this is true, then return true. Otherwise, return false. We'll click scan. And this should return everything that is moved from distribution into deceleration. So let's go ahead and take a look. We'll start with REGN, and then we'll check out Johnson & Johnson as well. So if we look at REGN, we see that we have in fact moved from distribution to deceleration. Perfect. And once again, Johnson & Johnson, we see the same sort of thing. Now, for example, let's say that you actually wanted to run the scan and see whether or not we were pulling back. Now, you could come into our market pulse, and we could just copy and paste this code right here, or even change these to plots if you wanted to. But actually, let's copy and paste this to keep it clean. So we can copy and paste each one of these 3 volume-weighted moving averages. We'll click no because we didn't change anything. Come and paste that in, and we'll just call this TIVWMA, and we can change each one of these to plots. And this way, we have 3 moving averages that automatically plot, and we can use that to determine whether or not we have a pullback. And so we can say I already have an indicator by the name of this, so we'll just call this V2. And now we can, before we actually run this, we want the 8 period to be a cyan color, we want the 21 period to be a magenta color, and we want the 34 to be a yellow color. And now what you see is we actually have moving averages that let us now treat this the way you normally treat a pullback to, let's say, the 21 to the 8 to the 34, whatever your preference is. For example, if you followed the 34, then these were your opportunities to get in, but we see that right after we changed into the deceleration phase, you didn't really get a chance to enter. So now you could wait for a pullback or continue scanning down the line and looking for tickers that aren't as aggressive in the sense of they aren't as extended. All right, let's go ahead and save this scan as the distribution to deceleration scan. All right, perfect. So now we have our 2 scans that let us identify the switches in market stages from both the essentially accumulation / distribution stages to either the acceleration or the deceleration stage. Okay, let's bring this home by now creating the utility labels that essentially give us this sort of information for a wide variety of tickers, and we also include in things like the 10-day moving average of the put-call ratio along with the trend. So we'll start by creating a new study, and we'll name this TI Utility Labels. Whoops. Okay, so before we actually bring in all of our code for this acceleration deceleration, we'll start with creating the labels for the TRIN and the put-call ratio. So we'll start with the TRIN first. The TRIN is one of those where if the value is above 2, then we say that we're overly bearish, and if the value is below 0.5, we say that it's overly bullish. So let's go ahead and transcribe this into something that actually is on our labels and something that we're always aware of, something that's always in front of our eyes. So we'll bring this in, we'll say def trin ratio, and we'll make sure we want to round all of these to the second decimal place. So we'll say round, and what we're actually looking for is the close of the trin. And so we'll essentially make sure that we've selected the trin, we'll round it to the second decimal place, and close this off. And now we want to give in both of those conditions of the overly bullish and the overly bearish. So we'll start with the overly bearish, and we'll say if trin ratio is greater than or equal to 2, then return true, otherwise false. And then we'll repeat the same thing for the bullish scenario. So we'll say trin overly bullish. We'll say if trin ratio is less than or equal to 0.5, then 1, else 0. And now we want to actually create a label that plots this for us. So we'll say add label. We want this to always be true. We'll say trin, and we'll give it the trin ratio. And so this way we know what the values are, but we want the label to change colors based on whether we're bullish or bearish. And so we'll say if trin overly bearish, in this case, so if we're overly bearish, then we're bullish overall on the market. So we want the labels to be green. So we'll say then color.green. Else, if trin is overly bullish, and so here we're more bearish. We're trying to be more cautious because the trin is telling us we're overly bullish. Then we'll change this to then color.red, and else we'll make this color.gray. Let's test this out. So we'll click OK. We'll hit apply, and what we see is there's an error with the label. So let's figure out why that's happening. So if we come back in here, we are missing the $sign on the trin. So we'll go ahead and add in the $sign in the symbol. And now what we see is voila, the actual label is printed. So the trin value is 2.08, which is above the 2, telling us that we're overly bearish right now. Let's go ahead and do the same thing for the put-call ratio. So the put-call ratio values are above 1, suggests that we're overly bearish, and then below 0.85 suggests that we're overly bullish. And these are the 10-day moving averages of the put-call ratio. So that's a little bit different than the trin. Let's figure out how we approach the 10-day moving average and bring that in here. So we'll start by saying def put-call ratio, and we'll once again round it to the second decimal place, except this time we want the 10-day moving average. So we'll say simple moving average of the close of, and the symbol is put-call. Let's not forget the $sign this time. We'll close this off. We want this to be a 10-day simple moving average, so we'll say this is a 10 simple moving average. We want to round this to the second decimal place. Okay, so now once again we'll create the overly bearish and overly bullish scenarios. So we'll say def put-call overly bearish, and we'll say if put-call ratio is greater than or equal to 1, then 1, else 0. And now we'll repeat the same conditions for the overly bullish scenarios. And so we'll say if put-call ratio is less than or equal to 0.85, then 1, else 0. And we want to finally add in an actual label that plots this once again. So we'll say yes, put-call plus, and then I don't really care about the actual put-call values, but I do care about the put-call ratio value that the 10-day simple moving averages shows. So we'll actually just plot the simple, or the 10-day moving average value, which is the put-call ratio as we've defined. We'll say if, and now we change the colors of the label once again. So if it's overly bearish, then we want the color to be green, and else if the put-call ratio is overly bullish, then we want the color to be red, and otherwise we want the color to be neutral gray. We'll close out that label and save this, and let's now test this out. Perfect. So the put-call ratio is showing the 10-day simple moving average shows us as 0.97, which is not above 1 and not below 0.85, and thus we're in the neutral gray territory, although we are super close to the overly bearish scenario, off by 0.03. Okay, now let's go ahead and actually bring in the values to now be able to understand which of the markets are in an accelerating phase, decelerating phase, or a distribution/accumulation phase. And the way to do that is we'll come back to our market pulse code, and we'll copy in all of this code straight into our utility labels, and then we'll start modifying it to essentially allow us to account for multiple symbols. So one thing that we're going to want to be careful for is a divider, just so we can keep things clean and organized. We'll make this the SPY, and we'll copy paste all of this code in. Now, once we copy paste this code in, let's get rid of all of the things that we don't care about. So we don't need the chart bubbles, for example. We also don't need to know when we're going from distribution to acceleration. We don't necessarily care about either of these variables. We also don't care about that or that. Okay, so we have this code right here, but what we need to do is we need to make sure that we add in the variable SPY in front of each one of these variables, just so that we can keep copy pasting this code into a text editor and do this in a slightly more efficient and faster manner. So the way we're going to do this is we'll make this SPY price, and we'll see a bunch of errors come up here. And once we get that, we'll say close, and then here we'll give this a symbol SPY. So you can be on any chart, for example, and we'll know that, hey, you care about the actual close of the SPY price or the SPY. We can't have an input, and so we change this to a def once again, change this to a def, and we'll make our length 21. We'll go ahead and create a new variable for the same thing. We'll do volume this way. And so we'll mark the volume. And once again, make sure we've assigned it to the symbol SPY. And now we need to come in, and anywhere we see these errors, copy paste in our new variable name, which is SPY price. And the reason we do this is so that we can then essentially copy paste this entire code, which now has SPY in front of all of our variable names, has SPY in these the close and the volume symbols, and we can just replace all for each new symbol that we care to look at. So we could do that with the SPY, the Qs, the sectors, so on and so forth. And so we'll do the SPY in this video, and then I'll have the code available for the other symbols, just so it's faster and a little bit more efficient use of our time in the video. So we'll make this SPY, and we change all of these prices to SPY price, SPY price, SPY price. And if you'd like to just copy and paste this code in, go for it. This isn't really anything to learn per se. This is just now a little bit more of the tedious copy pasting that is the inevitable woes of thinkScript. So I'll go ahead and stop this here. I'm going to go through and add in SPY at the beginning of each one of these variable names, and make sure to append all of these with SPY including in the temp, and then down here I'll make sure that I've actually replaced the volume with SPY volume and the close with our SPY price values from up here where we've defined them. So to save time, I'll copy paste this in. And so if I can go ahead and do that. All right, perfect. So as you see, this is how it should look like. We've added SPY in front of all the variable names, and so now you could come into your favorite text editor, for example, or even Microsoft Word, and simply just copy paste this code in, Control F, replace all, and anywhere where it says SPY, we'll do the same to now say capture in the Qs, the DIA, so the Dow, so on and so forth. Before we actually do that, let's click OK, and let's verify that the SPY is working. Okay, so as we see, the SPY variable has now showed up as red, suggesting that we're in deceleration mode. Let's verify that that's actually true. If true, then this first label should show deceleration, which is exactly what it shows. So we know that it's actually working the way we intended. Now let's create the variables for the remainder of the ETFs that we care to track. Now that we've finished pasting all of the code, let's take a look at the results and see what we can actually gain from this. So at a glance now, we have all of our utility labels. We have the trend telling us that it's overly bullish. We have the put call that's close but currently in neutral territory. We have most of the SPY sectors in deceleration mode. So anywhere, say you wanted to look for bearish opportunities, all of these red labels are where you could do that. XLP is currently in chop. Then once again, we have more bearish SPY sectors here, but the XLU and XLRE are currently bullish. So let's take a look at XLU and XLRE just to verify that that's working the way we think it should. So if we go to XLU, if you remember, we also found XLU in our scan, so that makes sense. And that is in fact on the acceleration phase. And now if we take a look at XLRE, we see that XLRE is also in the acceleration phase. And if you remember, this was not found in the scan because this has been accelerating for quite some time. We didn't have a switch. And so just like that, at a glance, you can tell exactly what's going on in the broader markets, which stage each market's currently in, and you have an immediate way to focus and know that, hey, you're looking bearish in all of these red labels, you're looking bullish in these green labels, and you can start down into the top holdings of each sector to then start to craft each trade. One more thing that you could do if you were interested in backtesting is to now go back to our market labels, or our market pulse rather, and let's say you came into something like XLRE and we turned these chart bubbles on. You could actually go back and use either thinkorswim's think back feature, which is right here in the Analyze tab, think back, and come into XLRE and actually start to go back in time to whatever date we saw the entering acceleration. So let's just use this as an example, for example's sake. So we had the signal on 130 after we essentially switched into the bullish scenario. So let's say that you bought a Delta 30 option on 130 and you held it till, let's just say Valentine's Day, 214. Well, what would that value have actually been? Let's take a look, and thinkorswim lets us actually track that fairly easily. So we'll come in here, we'll change this date to January 30th. XLRE, we could choose the Mars options for that given time. We'll bring this down. And let's say that you would have bought the Delta 30 options, which the bid ask was 20 cents by 35 cents wide. So maybe you could try and get that for, let's just say, call it in the middle, 27.5 cents. And now we want to fast forward to, we said, the 14th. So we could come in here, February 14th, and we see that it was at that point trading for 40 cents. And so that starts to give you an idea of how effective the options were in terms of trading each one of these switches from accumulation to acceleration, or distribution to deceleration. And you can go ahead and do this. Another fast way and slightly efficient way to do this is to use a tool like CML. If you've heard of them, Ophir has built a phenomenal tool. And CML essentially would let you go back in time and also start to understand which delta option might have been best on the certain date. You could start to plug in manual dates and see, like, hey, from the 30th to the 14th, this is what a delta 30, a delta 40, a delta 50 option would have done, so on and so forth. Hopefully, through this tutorial, you've learned quite a bit about creating labels, bringing in other labels onto, say, any stock chart. So you could be on Microsoft's chart, but really still be tracking a variety of other symbols not related to Microsoft at the bottom of your charts. We also learned all about the variable moving average. We also learned all about the volume weighted moving average, and we started to use the volume weighted moving average to start to find trends. We created an easy scan to start to identify these sorts of opportunities and capitalize on them, so you're not consistently staring at a screen or magically having to find out, hey, this is what's changing from acceleration to distribution, or so on and so forth. Everything is simple, everything is clean. And of course, all of this is free. So Alan, I hope, Alan and Ron, actually, both of you, I hope this tutorial helped both of you, but I hope it helped all of our subscribers as well. Maybe you saved a few $100s here from essentially buying this indicator. And if so, I hope that you can use that towards actual trading and start to risk that money to try and make money instead of just giving it away. Or, selfishly, a last plug, you could go ahead and sign up for the volatility box, and you could start to make the kind of money that we've been talking about in our daily reports. Once again, for the month of August, we're up more than 13 grand with the volatility box, which seems like a pretty damn good investment to me. Either way, thank you for joining me for the 7th tutorial. I apologize that this is a little bit longer, but hopefully it was of value and you were able to get something out of it. Thank you, and see you next time, and have a great trading week ahead.